Edgar, you can unmute yourself, and you are a co-host of this meeting, so you'll be able to turn on your video.
Okay.
Hi, good afternoon.
Afternoon. I'm sorry, I had a little trouble getting on, but here we are.
No problem. Okay, so let's start. Prafula, if you don't mind, if you see people like wanting to come in, you could admit them, and then we start with the call. Is that okay?
Okay.
Thank you. Okay, so let me take my notes. Okay, so welcome everyone. Welcome to this session of AI for Good in New York. So I'm Min Trin, and we have Prafula here. We are the co-host of this meetup event. So the idea is really to showcase example of AI use for good, but we also economists, and we work in finance, so we're also interested in the intersection of AI and finance. So we have invited Edgar today. So I'm going to give you a few minutes of a brief introduction, and Edgar also will tell you about what he's doing. So Edgar is a former asset manager and writers and researcher in investment management topics. So he's extremely well known. In fact, he wrote books when I was in graduate school, probably, that I found his book about if you Google chaos theory, fractals, and these kind of things, you always find his name, like fractals in financial markets. So he wrote very famous books in the 1990s. And we're going to talk about this. He has a website, edgarepeters.com, and also a new blog on subscription service. We'll talk about this too. So his research focus on market cycles, regime indicators, and they try to explain and predict the market environments. So he used a lot of interesting theories in finance. Some of them not like standard theories, but I think very innovative theories to try to explain markets, and more from a macro perspective. So he provides commentary, research, insights to help people understand the current market state and its impact on their investments and livelihoods. So he has also, if you go on the website, he has what he calls a market climatology model. Also about climatology, about the climate, where he compares, I think market cycles, market regime with the weather forecasting and climatology, I believe, and he'll probably explain us this a little bit. So he has a very interesting hypertext book that you can browse through on his website, and we'll talk about some of these topics. Even though Edgar Peters has not used this current version of AI that we see today, right? Because it's relatively new, but he has been an early pioneer, especially using what we call which are like fuzzy sets and fuzzy logics, right? Which is actually used in the 80s. It's part of the first, maybe you can say, the first AI models at the time. So let me start now, and today, so Edgar doesn't have a presentation, so it'll be more a conversation, and I think so. I have prepared a few questions, but we want to make it a conversation, and we'll open the floor to Q&As towards the end of the call. So you raise your hands, and you'll be able to ask the questions to Edgar. But you can always follow up with him. He has a website. He's on LinkedIn, and you can reach him by email too. So first, so tell me what I've forgotten about the description of what you have done. Tell us about your background. Even I'm not sure. Have you done did you do? Maybe you can start with your education and your interest in finance and how you studied in the field, Edgar.
Yeah, well, that goes back a long ways. Yeah, thanks. And again, I'd like to welcome everybody as well, and thanks for coming and listening to our conversation. Many of you don't know me. I've been in the investment business since 1978. So this has been 45 years. I've seen a lot of cycles. And that's one of the reasons that cycles is such an important part of what I do. And I'm also an early quant. Now, this is quant in the traditional sense, in that we use models to forecast markets. It isn't just trend following, which people tend to think is quant these days. And it goes all the way back to the early capital asset pricing model type things. I did study with Markowitz briefly at Rutgers, where I had my MBA. Many people think I have a PhD, but I don't. I'm just an MBA. And much of what I know about more advanced stuff is self-taught. Okay. I've been a practitioner for my entire career, though. While I've published papers and I've written books, I've always been a practitioner. Most of my asset management work has been tied to asset allocation. That's why I focus on the macro environment. Originally, I did tactical asset allocation at Panagora, and then at First Quadrant. And at First Quadrant, I also did risk parity type portfolios to try to get the strategic portfolio to be more efficient than a 60-40. Along the way, because I had a traditional quant background, capital market theory background, I found as a practitioner that most of that stuff is nice, but it doesn't work completely. It has a lot of heroic assumptions in it, is the way I look at it. And so when I came across chaos theory and fractals, it seemed to fit the markets better. The downside to using fractals and chaos theory and things of that order is that it guarantees you that if markets behave like this, that you can never forecast them perfectly. Okay, it just can't be done. And as I've told people when they started to work for me in the past, the thing about the market problem is that it actually can never be solved. So if you're one of those people, you want to come in and solve the market model, this isn't the field for you. Things will work for a while and then they'll stop working, and you'll wonder why they stopped working. And the reason is that regimes, the market environment changes. Okay, so just to give some background on my current stuff. It's based on the idea that markets have cycles, but they're interlocking cycles with other things that are overarching on them. And the reason I call it market climatology is it works a lot like the way the climate affects the seasonal weather, right? So one of the things that's going on right now is we're having a transition from a La Nina to an El Nino, right? Whether there's an El Nino or a La Nina in there determines a lot of the quality of the seasons in certain parts of the world. How we have drought in the Southwest or extra rain in the Northeast is largely determined by these things. The seasons come and go just like always, but how they behave is different. So within the markets, what I found is that in the long term, there are two cycles. There's an inflation level cycle. So markets behave differently depending on where the level of inflation is. And there's also a financial instability cycle tied to Hyman Minsky about how much leverage there is in the economy. And you can tie that in with the regular market cycle. And what happens in bull and bear markets and high and low uncertainty periods, expansion contractions in the business cycle, which are closely tied to the stock market, are determined by what stage we're in the financial instability and inflation cycles. So these things all link together. And I use fuzzy sets to determine what the indicators are, where we are. So that's everything in a nutshell.
Okay, thank you. So we can dig deeper into some of these topics. But just to tell you about climate. You're on the West Coast, so you haven't seen this. But in New York, New York today, we have the haze coming from the wildfires in Canada. So something that we haven't seen for a very long time. That you on the West Coast have seen, right? Like I think every summer you have the wildfires, so it's a very surprising event. So I don't know, it's probably not a Minsky event for us, but it'll be like
if it persists, it could be a real problem, But hopefully it'll dissipate over time. Actually, I'm in Maine.
You're in Maine. Oh, okay.
Yeah, interestingly, Maine is just missing this. It's sort of dipping down below us. Oh. It's coming from the north, dipping below us and going through New York and out to sea. So it's Massachusetts is
yes, and that's interesting. I think one friend flew to Toronto today, and Toronto the sky is clear. So it's so I like the analogy between weather forecasting on climate. But so the framework that you use, so can things be explained like a 2x2 matrix? So you have like the inflation, market instability, or leverage. Market, you have. I mean, you have a few factors. I think you have inflation, you have leverage, you have market uncertainty. So how do you combine these things?
Okay, well, there are actually four cycles going on. There's, and I combined the business cycle and the market cycle together because they're very closely related. There's a shorter term cycle, which is a reflation cycle. So this is whether inflation is increasing or decreasing, regardless of the level. Then there's the market uncertainty cycle, when you go through periods of high and low market uncertainty. This is tied to, some may know my fractal market hypothesis from 1994, and that dealt with how markets go through periods of high and low uncertainty, and that's a big part of the cycle there. And then on top of that is the financial instability cycle, the longer cycle. Now the market cycle lasts about 4 years. That's the average. The way to think of it, though, and this is an important part of chaos theory, is that it's a non-periodic cycle. Okay, it's not a random cycle, because there are random cycles where things just go along and they suddenly change, and you have no idea when that's going to happen. In chaotic systems, you have an average cycle length, like in this case 4 years for the market, but it can vary between 2 and 8 years. Okay, just the average over time is 4 years. The Minsky cycle lasts for anywhere from 8 to 12 years, and the inflation cycle is generally 12 to 20 years. So these are all much longer cycles, which the smaller cycles are embedded in. And I call the longer ones regimes, the Minsky and the inflation as regimes.
So you are lucky to have seen through. I'm not lucky. You are lucky to have seen through the early inflation of the 70s, right?
Oh yes,
1970s. That's that few people have seen today, I think.
Yeah. It's actually really funny. Back in 2018, 2017, I began to be concerned about higher interest rates and higher inflation, and I referred back to the 70s. And I actually got some pushback from some people on that in the company, the marketing people in particular, because they said, "Ed, why are you living in the 70s?" And I said, because that's the last time we had high inflation. And what you have with high inflation is exactly what we got this time. Bonds become a completely different asset class. That's what the regime shift causes. Bond volatility increases. The correlation with stocks goes up. They don't give you the kind of downside protection that they gave you in the past. All of that occurred in the late 70s and the early 80s, and it happened again in 2022. Everybody was surprised, but if you had studied back in those periods, you would have seen that that was a natural outcome of the current cycle.
So yeah, so tell us. So what were the early indicators for data scientists who want to build, like this inflation forecasting models? So people at the Fed probably have that. So how would you go in terms of how did you see that inflation was coming? Against against the public opinion.
Oh, it's actually I use a fairly straightforward method. I use a number of inflation indicators. The problem with inflation is a lot of people think of inflation as reflecting the indicators we have, the CPI, the PCE, the core PCE, et cetera, et cetera. The truth is we don't really know what inflation is. Inflation is just a concept, right? And so they come out with the CPI inflation and everybody anchors onto that and says, well, we have 12% inflation, but we don't really know what it is. We just know prices are rising. And when you look at all the different inflation indicators that are out there, CPI, PCE, PCE median, PCE trimmed mean, there are a whole bunch of them. They all follow their own path and they have their own averages. And so what I do is I take a bunch of these and I take the headline numbers because people anchor onto them. It's all about expectations in the end. They anchor onto those numbers. But the Fed actually has inflation trend underlying indicators, which are better than, of course, the headline numbers. And they talk about the ex-food and energy one. But in one of their own papers, they talk about other indicators, the ones that have that are done statistically different. One that uses the median, one that has the trimmed mean, it throws out the biggest numbers. And they actually found that those indicators are better measures of underlying inflation trend. And that's what we're concerned about, inflation trend, than the ex-food and energy one, but they use the X food and energy one because it's easier to understand, right? If you tell the public, oh, the trim mean PCE is such and such, who's going to know what that means? You tell them it's X food and energy, then people sort of know what it means. But you can get extreme moves in inflation indicators for things other than food and energy, which is what we saw back in 2022. So what I do is I take a number of these indicators, basically 8 of them, and I look at their activity relative to their long-term behavior, and I separate them into levels. It's a fairly straightforward thing. And when you get a consensus of them, and this is where the sort of principles behind fuzzy sets go, when enough of them are reading, say we're having moderate inflation or we're having high inflation, then you can think that inflation actually is high or low or median, and how do markets behave when we're in those levels. And that's what I use for that.
And how about, I think you mentioned that in some of your posts about, so you have the aspect of supply and demand, right? So I think you said that different causes of inflation, supply, demand, or too much money, leading to few goods. So can you like elaborate on that?
Yeah, inflation, that's the other thing, is that people also have simplistic ideas on inflation. Inflation, some people just harp on money supply, because mostly because Milton Friedman said inflation is everywhere a monetary thing, but that's not really true. And we've known that now for a while, since the money supply has been growing steadily, and we've had no inflation during the 2000s, right? So you can actually have inflation for 3 reasons. One is shortages, problems with supply. The other is increases in demand. And the third one is the money supply indicator, growth in the money supply. And it's fairly straightforward to measure these. And this is mostly for indications on what monetary policy can handle, right? So when it's monetary inflation, then monetary policy can handle that. If it's demand-driven inflation, then monetary policy can handle that, because the whole thing about monetary policy is to restrict the money supply and slow demand. But if it's a supply problem, then you can't do much about that, right? Interest rates do not affect supply. The only thing you can do is to try to bring demand down to supply, which is what you can do that, but it can be quite bad. But what's happened recently, just to this doesn't have anything to do with AI, but what's happened recently is that the Fed did say in the beginning that the inflation was transitory because it was a supply issue. They expected the supply chain to be fixed. What ended up happening was that it took longer for that to happen than expected. And because of that, inflation then spilled over into the other parts of the economy. And so then when wage inflation starts to pick up and when prices start to pick up in areas that are not having supply shortages, then the Fed has to begin to worry about that. And according to the indicators that are out there right now, the Fed raising interest rates has actually had no impact on the things that they can affect. All the drop in inflation that's happened so far, headline inflation, has been entirely due to those transitory things that they were talking about before. So we're kind of stuck in this 5% inflation level now. They've raised rates this far. It hasn't brought inflation down to 2%, and it won't. They're going to have to either raise it a lot higher, or they're going to have to wait for several years for it to get down to 2% at this pace. And it's probably not going to happen. So anyway, that's the thing about
one factor a bit related to AI indirectly is that, and in the past couple of years, I think now it's a bit better now, but they talk about a lot of a shortage of chips, microchips, or for cars or so on. And we make everything smarter, so we need more microchips, and we don't have enough, right? Or even EV cars, right? The demand of EV cars is good, but EV is like full of computer chips, and so they probably, in addition to the materials to make the batteries, or this is another issue. So, and you mentioned. So many of these things are relatively new, for non-experts. So let's talk about the fractal market hypothesis, right? And also, especially the link with the investment horizon. So can you tell us fractal first, and what is the scale, and how do you relate to investment horizon?
Okay, yeah. Yeah, the fractal market hypothesis is really the center of everything I do. It's what it was driven from. I published it in '94 in the book, Fractal Market Analysis. And basically what it deals with fractals not as repeating patterns in prices, right, which is what people think of as fractals. It has more to do with statistics. And the way to look at it is the thing about fractals is they don't have a characteristic scale, right? And by this I mean, when you look at trees, for instance, each branch has a generation, but individual branches in that generation are not the same diameter. They actually have an average diameter, and that's what scales according to a power law. But they're different because each one has a different reason for existing and what influenced its growth. The same thing is true of our lungs. This is the example I like the best because each branching generation of lungs, again, goes down according to a power law, but that's an average. Within each branching generation, there's a distribution of diameters. And the reason for that is that if there was an error when one generation was being formed, like it was too small, then that would affect all the subsequent generations. They'd all be too small, and the lung wouldn't work. It would fail. So what the fractal distributions on each generation do is they spread the error out. Okay, it makes the generation process in the lung in the end and the trees more resilient. Okay, so now we have to take this concept, which is a physical concept, and put it into a time series format. Rather than a characteristic scale, the fractal market hypothesis is based on the idea of investment horizon. Now, traditional capital market theory has, in its original form, has basically investment horizon doesn't mean anything. Okay, it doesn't matter how long you're going to invest for. Everybody has the same investment horizon, basically. Which of course is crazy because we have tick traders out there and we have institutions out there and they have very different investment horizons. And the thing about investment horizons is that the information that's important, and this is where the behavioral finance part comes in, the information that's important to investors depends upon your investment horizon. So if you're a tick trader, you could care less about the fundamentals, right? You're just following the prices and you're following momentum, and that's what counts. For institutional investors, on the other hand, it's all about the fundamentals. You know, they're investing for the long term, and while they may give it to managers to do short-term stuff, they themselves are concerned about the long term. So when markets are stable, you have investors in the marketplace who have all different investment horizons across the whole spectrum, from short-term to long-term. When you do that, information, the way it hits the market, is diversified. So what's bad news at one horizon may be good news at another one. So if the short-term investment horizon has a panic, long-term investors will see that as a buying opportunity. They'll step in and stabilize the market. So the market is stable in these cases. Now, what happens every few years is something happens which makes long-term investors question the validity of their long-term assumptions. Okay. And in the most recent case, of course, it was the pandemic. The pandemic made the long-term completely unknown. And when that happens, long-term investors either stop participating or their investment horizon shortens. But either way, the investment horizon for the total market becomes more uniform and it becomes shorter. And what happens, and when this happens, is when information comes into the market, investors interpret it in much the same way. Right? So if it's good news, everybody buys. If it's bad news, everybody sells. And so you basically have a loss of liquidity on one side or the other. All the trading is happening on one side, or most of it. And that causes the increased volatility that we see in those periods. Then later, eventually, the long-term becomes more certain again, and investment horizons lengthen out, and we go back to a period. So we have these periods of high and low uncertainty and volatility in the markets. And that's what the fractal market hypothesis is about. And these usually happen for fundamental reasons. Okay, so it's usually tied to the business cycle. So when we identify them, and that's what the main part of my indicator is about, is where are we in the market uncertainty cycle? And and that determines, because when we're in the high uncertainty state, that's when all the big negative returns happen. That's when you have fat tails in the distribution. Okay. A lot of my early work was about fat tails, which, believe it or not, back then was a radical idea. I mean, other people had come up with it. Mandelbrot talked about it in the 60s. But if you said markets had fat tails and that was important, usually it was assumed away. But the fat tails really mean something, and they show up during these periods of high volatility. So that's when you have the 3 standard deviation and bigger events that occur on a daily basis. And then when you go back to the low uncertainty environment, the tails actually get thinner than normal. Okay, so risk becomes lower, and actually average returns become higher. So it's going back and forth across these. Now, the nature of the high uncertainty period, though, depends upon largely the level of leverage in the market, and the economy. So if the economy is highly leveraged, then the downside is very large. If the economy and the market are not that leveraged, then the downside is not that big. So you get volatility, but you don't get the big downdrafts. So that's the way all of these things interact with one another. That's why you need to know when we're in the high leverage state, the Minsky cycle, and when we're in the high volatility state. When those coincide, that's when you have to worry.
So the fractal market hypothesis. So it's sounds it's very different from the efficient market hypothesis, right? Of course, which is like the benchmark in academia. On the efficient market hypothesis is that markets are not predictable, or like beyond the risk premium. Right? You just you have the risk premium, but beyond that, you just have a random walk. So what does the fractal market hypothesis says in terms of market predictability? Also, are markets predictable? They're a little bit predictable. They're not predictable at all, because the things, patterns never like reoccur exactly. So what does it say?
Yeah, they're somewhat predictable, and they're predictable over intervals. And the reason is that the actual motion of the market is not a random walk. It's a biased random walk. Okay, so the bias is in one direction, which basically, if you were throwing dice, it means for a while you're more likely to get 5s and 6s, and then later that goes away, and you're more likely to get 3s and 2s. It changes over time, and that's the reason when you do have you do have periods where things are purely random, but they don't last that long, and that's the big difference between the two in that regard.
Today, I was listening. There was an interview at Bloomberg of Gertrude Miller. Gertrude Miller, the lieutenant of Soros. He was saying that. So he was talking about market forecasts and so on. And he was telling the audience about an experience that he had in March 1999, where he thought there was a .com bubble. So he shorted. He said, I think, $200 million. Number might not be accurate. Around $200 million of .com stocks, 12 or 13 stocks, .com and so on, that he thought were widely overvalued, which was probably right? But within a few weeks, he lost like $600 million on his all right? It's because
I remember that time.
Yes, but at the end, all these 12 stocks, all 12 companies went bankrupt. So he was right on the long run. But the short run, of course, you have to close his position, right? So this is a case where, true, there's some predictability. We know it's overvalued. We know that they are going to go to zero, but the timing is so difficult, right? So even the fractal market hypothesis gives a bit of uncertainty, but we don't know. So the cycles are 4 years, but it could be shorter, it could be longer. So how do you resolve this timing issue?
Well, you can never resolve it completely, okay? And even in the indicators I have and the ones I have now, they still have the beginning of a high volatility period in the 90s started with the Russian financial crisis in August of '98. And after that, it was high volatility. And if you allocate based on volatility, and that's what the risk parity thing is all about, you would have cut back on your equities. But the idea of pulling out of equities or shorting the market indefinitely, those are strategies which you have to have a lot of capital to be able to continue them. See, and that's the problem with them. So it's not a matter of in forecasting it, 100% correctly. It's how you invest when you get that kind of forecast. Are you going to bet it all on it happening soon? Because you could be quite wrong on that. Like right now, it's very possible that we are entering into an AI type bubble, but it could go on for 2 or 3 years, right? Because one of the conditions for a real mania to develop is usually low interest rates, which we don't have. So it could continue for quite a while. And that's why it's really your investment strategy which matters. Are you doing something which is sustainable? Or are you betting the farm on your ideas?
Like today, actually short NVIDIA when it reaches $1 trillion market cap. No, you could do that, and it could go to 2 trillion. Right? Who knows?
Yeah. I mean, look what happened to Cisco in the tech bubble. In tech bubble, Cisco went to what was it, 300 times earnings, I think, if I remember correctly. Now it's around 30 times earnings. And the funny thing is that the stock, the company has performed admirably the entire time. But investors back in 1999 discounted basically 30 years worth of good earnings.
So to go back to the fractal market hypothesis, so what empirical studies have been done to try to test the hypothesis?
Yeah, that was one of the issues with the hypothesis when it first came out. I had the same problem that basically Hyman Minsky had with this, is there wasn't the technology to really test it. It was all based on, I based all my findings on the fact that I found these volatility regimes, and that showed that things were changing, and the returns changed in the two regimes as well, because I could determine those. But the actual hypothesis itself was difficult to test, and it wasn't until there was wavelet transforms that were widely used that the hypothesis itself could be tested. So a number of academics have tested the hypothesis using wavelet transforms. And because I found I published it in '94, we have 3 really nice out of sample market crashes to go through, not crashes, but high volatility periods. There's the tech bubble, which happened after that, the global financial crisis after that, and of course the pandemic of 2020. So what they found is that in each case, because wavelets look at what's the dominant frequency during a period, right? And what they found is that during the periods of low volatility, like the 90s, the middle 2000s, that there is no characteristic frequency. It's completely noise. But once you get to the crisis period, then the frequencies become, the high frequencies dominate. So everything shifts then to the higher frequency trading and higher frequency data, which basically confirms that in the fractal market hypothesis, that is exactly what's happening. Investors are shortening their investment horizons. They're trading together, and that's what's causing the change in volatility regimes.
Maybe a more traditional approach would be to look at asset correlation or correlation of trading position, right? So in terms of crisis, they all trade the same, right? So all the correlation of risky assets go to 1, right? So
right. Yeah, well, that's what I had before, but I was told that didn't prove that investors' investment horizons were shortening and lengthening. Right? It just showed the markets were getting more volatile. Well, yeah. So the wavelet transform, though, the wavelet stuff was actually able to determine that empirically. I have references to it on my website. The best one is by a gentleman called Christofek, and he did it before the pandemic. I believe other people have done it since the pandemic, and found it works on multiple markets, not just the US. It works on multiple markets.
There's an academic, I remember reading his book like a while back. I think his name was Didier Sonnet at UCLA. So he's he tried to connect finance on seismology, right? Like predicting earthquakes and predicting, market crashes. How is it related? I
actually talk about him in I think the 96 book, yeah.
Mhm.
He was already doing that then. The sand pile stuff, yeah.
Yes.
Yeah, what he found was there's a critical state. And the critical state is basically that low volatility period where all the investment horizons are diversified.
Yeah.
That's the critical state. But what can happen is you get landslides periodically. Those are the
Yeah. So it's kind of related to the Minsky, like Minsky cycle too. So maybe can, like, for people who are not familiar with Harry Minsky, like, can you tell us a bit, what we found, how it became credible throughout during the global financial crisis and so on? So, not familiar.
Well, there was
why he was not. I mean, he invented this a while back, but people didn't listen to him, right? So.
Right. Well, he had the same problem I did with the technology to prove that his process was working was not available to him, and so he was criticized for that as well. Basically, the Minsky cycle says that the financial system sows the seeds of its own destruction, is the way he puts it. Okay, there are levels in the beginning of the cycle. Assets match liabilities, or assets are actually more than liabilities. And he called this sort of normal finance, when people borrow money, but they have assets to back it up. Then eventually there's a period where things become speculative. And that period, because gains from asset values are declining somewhat, people start to leverage up. But their leverage is not so much that if they're wrong, that their asset values are less than what they owe, right? And so this is speculative finance, and this actually can be a good thing, right? And it's what most people do anyway, most of the time. You have a certain level of leverage in your financial statements. Companies have to borrow money. If a company has no leverage, then they're not going to grow, right? I mean, that's the way it goes. But eventually, what happens is, usually because interest rates become too low, is that the capital gains again become lower, and so investors and banking start to borrow even more, and it gets to a point, he called it Ponzi finance, where the leverage is so high that the only way you can make money is on the capital gain. Okay, you don't make money from the income anymore; it's all from the capital gain. And if the market collapses, if the asset value collapses, that causes basically a downward cascade in the financial system, where there are calls for more assets. People sell their assets in order to cover them, and that causes a huge downward spiral until you end up with a normalization again in the financial system. These seem to be happening a little more frequently now, but the financial crisis was the great. Well, the Russian financial crisis was the first instance of it. And a writer at Newsweek coined the phrase Minsky moment for that time, because that's what was going on with long-term capital management right there. And other financial institutions were so tied in with long-term capital management that they were going to have trouble, particularly the banks. But the global financial crisis was the biggest manifestation of this in our lifetimes, where because of the real estate problem, asset values were so high leverage was so high for people that when their asset values declined, they could no longer cover their loans. And that caused the downward spiral, and then the global financial market collapse. Those happen every 8 to 12 years, okay, technically. And so when those happen, then you have a serious downside in the markets. If they don't happen, if you have just something like we did in 2016, let's say, where we had very turbulent markets, but there was not excessive leverage in the marketplace, then you get a lot of volatility, but you don't get the big downside. Okay, and that's the difference between the two. So I call the one side where there's no leverage a turbulent market, and the other side a fragile market, and you have high leverage.
So you have built cycle and regime indicators, right? So to follow the different cycles that you have mentioned, market cycle, inflation cycle, and so on. So can you tell us how difficult today we hope that an AI could come up with these indicators of and use the features, feature selection and so on. But how do you come up with your if we wanted to have today AI Edgar Peters to help us find the features,
Okay.
how should we do it?
Well, the way I've done it is fairly straightforward, I think. But when I was back in the 90s, I was also very interested in artificial intelligence, and I studied neural nets and other things like that. But the approach I found, which was at that time in particular, was the most useful, was fuzzy sets or fuzzy logic. And fuzzy sets were basically a way for us to quantify uncertainty. Okay, the way people make decisions under uncertainty.
Maybe you can, maybe for the audience, define us, help us explain what is a fuzzy set. Maybe for
yeah, I'll be glad to do that because it's a very important concept. Fuzzy sets basically, if you're familiar with behavioral finance, it's the representative heuristic is what's going on here. And fuzzy sets are based on the idea, well, the formal part of it. Now, you know, traditional set theory, which the fuzzy set people call crisp set theory, is very binary, right? In that one of the axioms in it is that a set and its complement, the intersection of a set and its complement, are the empty set, right? And that works fine with when you're classifying objects and a lot of things. But there are a lot of things where that doesn't work. And one of the examples I often use is because I'm only 5'7", you know, I'm not a tall guy, and is how would you classify the set of tall men, right? If you, what I'm going to show you is that traditional set theory cannot handle a concept as complex as tall. Tall is too complicated for set theory. So how do you determine what the set of tall men is? Now, in the West and in the United States, you know, a tall man is 6 foot or taller, right? That's the sort of rule of thumb. So it's 6 foot or taller. So you would say that, okay, all men who are 6 foot or taller are tall, and everybody else is not tall. Okay. But that means that somebody who's 5'11" and a half is down there with me at 5'7" in the set of not tall men. That doesn't make any sense, right? That guy's almost tall. So how does that work? And in fuzzy sets, what you do is you actually set not only a upper threshold, you know, but a lower one as well. When do you know somebody is really tall? Okay, we'll say 6 foot. But when do you know somebody's not tall? And to make it easy, I'll say it's 5 foot. So we all agree that a man who's 5 foot tall is not tall. Okay, a man who's 6 foot tall is tall. Everybody in between is in between. And what happens in fuzzy sets is you can belong partially to the set of tall men and the set of not tall men, depending on where you are on the continuum from 5 foot to 6 foot. And you do it from 0 to 1. So you say 6 foot, you belong 100% to the set of tall men. If you're 5 foot or less, you're 0% in the set of tall men. Somebody who's 5'11" and a half would be 98% in the set of tall men and 2% in the set of not tall men. Okay.
But
Me at 5 foot.
This is a bit different from like logistic regression, because a simple regression would give you probabilities of being tall and small or short, right? But, yeah.
Right. Well, this is not about probabilities. It's about state, right? It's not about probabilities. We don't know the probability that I'm a tall guy. We know that's 0. But depending on what the probability is. But when you do this, the thing is tall, basically, this is just to show that tall is a concept. It's too complicated for set theory. So what do you do with something more complicated than that? Like, when do we know we're having a recession? Okay. Okay. And the truth is that recession is one of those concepts. We don't really know when a recession starts, and we don't know when it ends, even after the fact. The NBER in the US has a set of criteria for recession. They don't tell us what it is. We know what it was in the 70s because somebody published it, but we don't know what it is now. But when the economy passes through a certain number of these criteria, then they declare there's a recession, right? So it's all based on how similar the current state is to the state where they know there's a recession. Okay, that's what it is. It's a similarity between them. Now, and so this is the way I use fuzzy sets. For market uncertainty, I have periods I've classified as high uncertainty periods and periods that are low uncertainty periods. And I look at how similar is the current state to that state when we know that we had high uncertainty, okay? And in the case of the financial cycle, it's when do we know we had a financial instability period? And how similar is the current environment to that period? You know, is it high or is it low? If it's exactly the same, then it'll be 1. Or if most of it's the same, it'll be a 1 or 100% like that. But if it's only 20% like that, then I'll say we're not in that, right? So that's the way you classify things that are uncertain. And it's the way we all make decisions anyway, for the most part. You know, because most of the decisions we make, we don't have probabilities. We'd like to think we do. And Kahneman and Tversky showed that even if we have the probabilities, we're unlikely to use them because we instead decide that we're going to use a similarity of something we know. And in this particular case, because there are no probabilities, you know, we really don't know the probability of having a recession. What we do say is we know the similarity between the current state and other times.
So similarity will replace the measure of distance, like distance between, I mean, in standard machine learning, they do, you know, you calculate the distance between, you know, a target and
well, you can use that as well.
Yeah.
You can use that as well. Usually what people do in AI, or at least what they used to do, was you'd use a combination of fuzzy sets and neural nets together and machine learning, you know, because a lot of the tree learning behavior that's used in modeling is tied to fuzzy sets. There's fuzzy trees and all sorts of things like that, which you can see in the literature. Those are all using fuzzy set concepts. Okay, because that's the best way to make a decision in a situation of true uncertainty, where you don't know the probabilities and you can't calculate them even after the fact. You know, people used to ask me when I was investing for them, what's the probability the Fed's going to raise rates? And I'd give them a number, okay? But it wasn't a probability, it was a similarity. How similar are current conditions to times when I know the Fed has raised rates before? Okay. That's what we actually say. We're not saying what the probability is, we're saying the similarity. And there's a difference between those two, you know, and the thing about it is if you use these fuzzy concepts for modeling states, then you get something that's much more robust and understandable than when you try to use other methodologies using probabilities, you know, statistical methods.
Recently, so let's shift gear. We talked a bit more about AI, but how would you use AI today for instance, you are proposing now you have a model portfolios, right? So you have model portfolios, you give your views about underweight or overweight assets or sectors or so on. So how would an investor would use machine learning AI to do that, for instance? Or if you have, for instance, someone were to build an AI for you, what would be the requirements? What would the ideal AI do for you?
Yeah, I'd certainly like to see some more advanced methodologies for figuring out where we are in the cycle and the regimes, right? I don't see a lot of people working on that because people don't think in very long term. And one of the reasons I think is one of convenience. The problem with long-term things, like we were talking about inflation earlier, the last time we had high inflation before the 2020 was back in 1982, right? And there wasn't a lot of data back then, you know, and a lot of things that we used to trade with trade now were not available then. Believe it or not, back then there were no gold futures, there were no oil futures. They didn't exist yet. They showed up later, and there was no VIX or anything like that. None of those things existed. There were no index futures, you know, until 1982. So it's a very different environment. So it's very difficult for people to look at these very long-term regimes and model them. But we need the ability to do that. And there is data around, and there are things that can be done to modify this. So for me, I'd like to see someone come up with a methodology which gives us something flexible, which is not based on probabilities. something we can understand as well, not a black box, something that can tell us what's going on, and something that's adaptable to what's happening right now. And I think with AI, what we're going to see in the coming years is that AI will, as has been talked about, take care of a lot of the more mundane things that people do, and from an economic standpoint, that actually is a problem, because it means more and more these sort of low educational level jobs will just cease to exist. They just won't be there. I've already seen it in my lifetime. My father, I came from a blue collar background, right? My uncles all worked at Ford factories assembling cars. Their jobs, they don't exist. They're all done by robots now, right? And we can expect that some things, and some of them are things that are very highly paid, like being an accountant. For instance, accounting is fairly straightforward. It probably can be handled by the right AIs and so forth. And so we're going to see a big shift in the way people work. Now, there will be new jobs, of course, that come from this, and that's what always happens, but there will be a transition. But there's bound to be, frankly, a group of people who will not be employable. And how do we deal with them? We can't just let them loose on the street, right? And so we're going to have to come up with something for that.
Yeah, I think some people came up with we had that Andrew Yang, like the presidential candidate, talking a lot about freedom way, or UBI, or the
basic income.
Universal basic income.
Yeah, and there's a possibility that something like that will have to be done. I don't know what it is, but what people will accept, but it is something that's coming. And so even in our industry, where there have always been, I was not originally in this business. I started out in IT, except we called it data processing back in those days. Most of us early quants were programmers because you had to write your own code. There was no off-the-shelf stuff to do optimization even or anything, and compile data. But these days, all that stuff can be done easily, right? I created my website by myself. I didn't even need to know how to code in HTML. Right?
Okay, yeah.
Right? That stuff is already there. So people who depended on being able to create websites, a lot of what they have is not necessary anymore. And that's the sort of thing we're going to be running into going forward. But at the same time, it doesn't appear that the more creative aspects of what people do will be taken over by AI. So there will always be a need for people, because creativity, after all, is making connections between things that are new. And in general, what I've seen so far from AI, ChatGPT, and all that stuff is it basically compiles stuff that's already out there.
Yes.
Right? There isn't any innovation coming out of that, and so innovation still has to come from people. And until we get to a point where maybe quantum computing will allow us to get cognitive machines, we're still going to need people to come up with innovation, and innovation is what's.
I see, Prafula, do you have a question? So please go ahead.
Yes, I had a question. I think this is a very interesting discussion, but I am still trying to grapple with this concept of, depends on which state the markets are or the economy is, is it very high uncertainty, low uncertainty, or, whatever. Is there a certain foundation or certain foundational principles, okay, underlying this type of analysis, where you say that, okay, a state of a market is defined by these 5 characteristics: high uncertainty versus low uncertainty, the high volatility versus low volatility, and high returns. There is a bias in the random walk, and it depends on how much the bias is, etc. And so these 5 characteristics are going to be my foundation for analysis. Okay, what are those? I didn't understand that. Or is it like, tomorrow the number of characteristics may go from 5 to 7. Okay, and then we do some data mining and we say, oh, it looks like today there are 7. Okay, and then they may decline to 3 tomorrow, day after tomorrow. So what are those? If you want to analyze markets, what characteristics should one use to define the state of the market? That's my question.
Okay. Well, I have several that I use. Okay. And others have others that they use. For me, there's a combination of equity risk, which comes from, which I measure from implied volatilities, and I use it from multiple indexes. Credit risk, and here I look at investment grade credit risk. You can use high yield risk as well. Is credit risk high or low right now? Is implied volatilities implying market risk is high or low? Then I look at global business conditions coming from the PMI tied to manufacturing. The manufacturing tells us a lot about the state of the economy. Interest rate risk based on the shape of the yield curve and things that are happening there. And finally, the level of leverage in the marketplace, okay, which I get, in this case, it's more tied to the financial markets. And I use a combination of the MOVE index in conjunction with the others. If you want to look at that stuff, you know, it sounds like a plug, but it is all outlined at my website, okay, which again is edgarepeters.com, which is hard to forget. There I have a hypertext book which goes through the concept for the regimes, the way I see them in the market climatology type approach, and the intersection of these separate regimes, and then how you look at the individual regimes and measure them at the same time, and then how you connect them together. It gives you an overview there on how to do that, and there are references too, so you can then go out and read on other people's stuff if you want to. So it's not something that can be collapsed in a short time period, but it's all there for you to look at. You can take a look at that.
Okay. Thank you.
Sure thing.
Edgar, so during your long career as an investor, you must have, I mean, AI is new and not new, right? I mean, AI has been, you told us that you had already experience before, but during your career, I'm sure many people may have pitched you about, you know, using AI in your investment process and so on. So what was the experience? And you probably didn't buy it, but what were the weaknesses that you saw? Or like, is it because there were black boxes, or they were like, you know,
yeah, they were.
Yeah.
That's a good question. Yeah, they were usually black boxes if somebody were talking to me, but because I was constructing my own models, right, and the firm was constructing models, it was really a matter of finding out about methodologies, and we usually talk to academics about that. But I have to tell you that in the marketplace, though, now I was an investor for institutions, right, pension funds, foundations, endowments, and when I first came around with the market risk indicators and I talked about fuzzy sets, you know, in a very general way, like I did here. Nobody wanted to hear it. You know, when you defy conventional wisdom, it sounds complicated. Now, it's not really complicated, you know, but you just have to think in a different way, and not everybody wants to do that. And so it was a hard sell to tell people I was using an element of artificial intelligence in the models. They didn't want to hear it. These days, I think because there's some hype behind it going on out there, they'll probably be a little more amenable to it. In fact, we may get to a point where people have to have it in their models, or have to say they have it in their models in order for them to get clients. But at the time, it just wasn't there. So it could be that this is the time when AI will finally become more respectable. I hope it doesn't become overhyped, because it's a very important technology. But, you know, the internet became overhyped too, and it survived. It's very useful. We still use it. So I'm sure that even if AI becomes a bubble, the way the .com thing did, it'll still come out ahead in the end.
So tell us about your, so like many of us, you probably have experience with ChatGPT and so on, or this generative AI. So what were you, I think you put some funny post about it, you know, but so
yeah, I did.
What is your experience? What is the pluses and minuses that you've seen, or any potential or downfall? I mean, Jan LeCun, who is like, you know, the Turing Award winner and who works at Meta, predicts that we won't talk about ChatGPT and large language models within the next 5 years. Maybe in 5 years, nobody will be talking about it. He wants to push his own model, so he's a bit biased. So tell us about what do you think?
Okay, well, first the things I did find useful are the art ones, like DALL-E.
Yeah.
Some of the illustrations on my website I got from Dali. You know, I said I want an iceberg in the style of Rockwell Kent, and it drew it for me.
Oh, okay.
You know, so I did stuff like that, and so getting some graphics like that were very, very positive. The funny story was I actually asked ChatGPT, the basic free version, about me. I said, "Who is Edgar E. Peters?" You know, and it gave me a very long biography, which was mostly wrong. It always got that I wrote the books, but it usually had me born at the wrong time. It had me going to the wrong universities and getting PhDs. I always had a PhD there. Sometimes I died. I died in 2008 in one case, 2012 in another. It very nicely at the end added that work on my theories continues on after my death, which was kind of nice. But you know, it was just, and each time I went through it, it didn't get any better. You know, it just threw in new stuff. It seemed like it wasn't actually searching in a coherent way, because if it knew about the books, there are bios tied to the books, and you could get information from that. But it didn't do that. It got information from something else about some other Edgar Peters or something else, and threw that in there instead. Now, I've noticed recently that it's actually seems to be restraining itself. So it doesn't go off and make any wild conjectures anymore about things like when I was born and died and all that. But it also gives a more limited answer. So so it appears that
it'll be easy to check. I think maybe Google Bard might do that. Because they can Google search and look at your Wikipedia page, right? It's just as a
exactly.
You're still alive, instead of conjecturing that you passed away.
Yeah, exactly. I mean, I have there's a bio of me on Wikipedia. There's one on Amazon. I mean, and there used to be one on First Quadrant. There's one at my website. You know, well, on LinkedIn, not on my website. I don't have anything there, but LinkedIn has most of my stuff, and it didn't use any of that. So it was kind of funny, you know. And so that for that reason, you have to be careful, like the lawyer who used it to write a brief recently, and evidently the AI chat GPT quoted about 10 cases to support its case, except none of those cases existed.
Yes.
And he didn't check them. You know, so you have to check.
I found that for references too. You know, if I ask ChatGPT, give me some papers that study this and that, and sometimes half of the papers don't exist. No, they're plausible, they sound nice, but they don't exist. So it's an issue. So in terms of, so this is like the negative. So this is a hallucination, right? The fact that it hallucinates things that don't exist. Maybe plausible. They could be plausible in a parallel universe. You know that. In the parallel universe, you would have got your PhD, PhD from MIT or Caltech. I'm pretty sure, right? But it just in this universe, it didn't happen. I mean, in terms of anecdote, I had also we did that with some other friend. One of my friends is a French mathematician, and when I entered his name, ChatGPT told me that he received the Fields Medal in 1992, and so there were two things. So he never received the Fields Medal. There was no Fields Medal in 1992. So the Fields Medal, right, for people who don't know, it's like the Nobel Prize, but for mathematics.
Right.
But it would have been plausible. But because his bio, he was on one of his top French schools. He did teach mathematics. So his bio looks very similar to people who received the Fields Medal. Right? So I think it works by extrapolation, because it's just like predictive. So I think because of your research work, it looks very likely that you have a PhD, even though you don't have it, because of your publication, your research, you'll be a PhD type. So I think that's you would expect.
I'm sure a lot of people make that mistake. I often get mails addressed to Dr. Peters.
Oh, okay.
Because my son's the only one in the family who has a PhD, so it's not in math either. So, but it's.
So in terms of pluses, so what do we see the plus of things that potential like use to for these like generative models or ChatGPT or future version of ChatGPT? What an investor could find useful, or someone interested in investing, or
Well, right now, I think from an investment standpoint, the applications are quite limited unless you can embed it inside of some other large a program, which is what's already happening anyway in a lot of places. So what will happen eventually is there'll probably be better dialogue with these machines to come up with things, to do analysis, but you'll have to be very specific about what it is you want. You know, it's not going to solve the mysteries of the market by itself. And like I said, there is no answer to the mysteries of the market. I've often compared the market to a virus. It evolves to continue its own preservation. If there was a perfect method for cornering the market, you know, for making money without risk, then somebody would have figured it out by now, and then they would corner the world's wealth, and that would be it. The market would die, right? Mm-hmm. So the market perpetuates its own existence, and it does that by evolving. So whatever drives the market in the long run, or particularly in the short run, but even the long run, changes over time. And so it's going to be very difficult for anybody to come up with anything that works all the time. You know, everything has to evolve.
In the fields of finance, it's more like econophysics. You have this what they call the ABMs, like agent-based models. Well, so agent-based models, so they simulate traders and so on, and they try to study the macro behavior. So we have like AI-based simulated agents, and say, well, you have these agents that trade like short-term traders, or some of them like long-term traders, and simulate the whole market and see how it behaves.
Yeah, there have been people who've done that already. So there have been in econophysics, and where they also have come around to the idea that investment horizon is important. Okay, and so they differentiate between investors with long and short investment horizons. So there have been doing things there, and so sure, market simulations are important. But the big problem is that you can only use that, though, the agent-based model idea, when you're looking at trading. Okay, and if trading is all you're concerned about, well, these days there's the Bitcoin markets, right? Those are just pure trading markets. There's no fundamentals involved there, right? There's no fundamental behind Bitcoin. It's all pure trading, what people are buying and selling because they think other people are going to buy and sell. So the difficulty in simulating the market is how do you simulate the fundamental environment behind it? Again, the whole thing with the financial system, periods where there's leverage and periods where there's not leverage, periods where their investments are highly uncertain and then not uncertain. It's those sorts of things have not been simulated yet. I haven't seen that. And if we're going to really come up with things to explain how markets work and how economies work, you know, it's going to have both these long-term and short-term things embedded in them, and maybe that'll be possible with more sophisticated models tied to AI.
Yeah, I guess we have to simulate the whole economy. So workers, consumers, employers, firms, markets. So it's a bit. Who knows? Maybe one day. I mean, economists have tried to do that with these. There are these big macro models that they run in at the Fed and so on, but they're very rough approximation. They're also subject to the Lucas critique too, right? This is all because of expectation and so on. So even you build something that that might simulate the whole economy, but agents know that you're using this big machine, so they might also not try to unwind whatever macro policy you might derive from this model. So it's a bit quite complex. So in terms of so in your so I was thinking of this expectation like Robert Lucas. Robert Lucas, the economist, passed away recently. So he was the famous macroeconomist who talked about this Lucas critique. Exactly that. You cannot forecast the model with a big model because agents will know that you use this model and they can unwind your model policy. So to what extent the fractal markets or chaos theory is rooted in the fact that agents can have expectations. So they will expect what you would expect, and they expect that you expect what they expect, or there's this kind of equilibrium. So there's a fundamental uncertainty tied to that we're not just particles, like physical particles or atoms.
Yeah, well, the thing about that is that again, when investors have different investment horizons, they can't expect what you're going to do if they're not in your investment horizon. Okay. And so it's really a matter of how many investors are out there with diversified horizons. And when that happens, it's very difficult to predict exactly what people are going to do, what investors are going to do. And it also dampens down the volatility quite a bit. Okay. And it's for this reason that the agent-based approach, or the approach to model markets strictly by looking at trading, is so difficult, because you don't know what's influencing different parts of the market, different parts of the investment community. In some cases, they're not influenced by short-term stuff at all, and in other cases they are, and in some cases not influenced by long-term stuff at all. I remember one thing that happens in the low volatility state, for instance, is that economic information carries very little weight. Nobody cares. Nobody cares then. They're looking at other stuff. Inflation, GDP, all that stuff. Nobody cares. And so if you do a standard like regression type model or any of those types of models, and you have all of these periods at once, you get mediocre results, because in this period there's no information there. And then in this period, though, it's very high information. So one thing about having regimes is in which state which information is important. So if you can say that we're going into a high volatility state now, so macro stuff is going to be important now. In a low volatility state, macro stuff is not important. Okay, that's the way that you would use this type of approach.
And when you are investing, have you ever wondered what the other guys were doing, what the other large hedge funds and investors are doing, or also you invest in FX markets? You have to think about what the other, what the central banks want to do, or
oh yeah. Well, different markets are different, and FX, which we did a lot of at First Quadrant, are very different. FX doesn't have the kind of cycles that the business cycle does, mostly because there are massive players where return maximization is not their objective. Okay, the central banks are not trying to maximize their returns, right? And so their objectives are different than yours, but they're the ones who are moving a lot of the market a lot of the time. And so you have to be very careful in that environment as well. Those you can think of it as the central banks have an infinite investment horizon. So they don't really care about the near-term effects of what they're doing. And so that definitely has an impact, as far as that goes. Sure. What from a practical standpoint, when you're investing as an asset manager, you have to think about who's actually going into the market now, and who are the participants that are playing the market at this time. Is it the hedgers? Is it the speculators? What's driving things at the moment? One of the reasons, for instance, I like the implied volatility indexes is that they're really, as measures of volatility, they're pretty bad. They never forecast volatility correctly. Yeah, they only forecast whether it's high or low. They don't forecast what it's going to be. But what they are telling us is what is the price of hedging your portfolio. It's a standardized thing, right? Because options, of course, have different maturities, and you don't know what's going on. But the VIX and the other implied volatility indexes basically give you a standardized index for the cost of hedging your portfolio. So when the VIX is rising, it means that the cost of hedging your portfolio is high. Why would the cost of your portfolio be going up? Hedging your portfolio be going up? Because the option writers are afraid they're going to have to pay off. So they're charging you more for the insurance. In the low volatility period, they don't worry about it. They just collect the premium, so they don't charge you much in that environment. So it tells you what the expectation is about the direction of the market and the volatility of the market. And that's what it's really important. Those indexes are really important for. That's not completely true of the MOVE index, which I write about quite a bit, because the MOVE index can also move when literally.
Can you tell us what is the move index? What's the definition of the move index?
Well, the move index is an implied volatility index for treasuries.
Okay.
Right. It was originally put out by Merrill Lynch. I think that's what the M was for. I forget what the whole thing stands for now. But basically, it's an average of 2, 5, 10, and 2, 5, 10, and 30-year treasury options, right? And it weights them, and the implied volatility of them. And people mistakenly think that when the move goes up, that means that the risk of bonds is going up, and they treat it just like the VIX. But when there's a panic in the stock market, there's basically a blowout in bid-ask spreads in the treasury market, because financial market participants, institutions, begin to hold back on treasuries. They don't put them out to market. So the actual supply of treasuries in the market is down when people want them the most. So bid-ask spreads blow out and volatility increases. Okay, but bonds go up. They don't go down like with the VIX. You know, when you get a big move up in the VIX, its stocks go down, right? But a big move up in the move may not mean that the downside is there. So it gives us an indication of what's happening as far as liquidity in the market goes, and then it also gives us a standardized number. So in that way, you can see what is the sentiment of option writers, which is a very important part of the market to find out what's going on. And that's why things like that are important. So I do pay attention to those things.
Is what you said applicable to commodities too? The commodities market? You didn't mention, like, I mean, there are also cycles in the commodities market on some, but you didn't mention it. Is it
the commodities?
Yeah, specific to each market, oil and agriculture and some. They are very different.
No, there is. With commodities, there's a separation. Commodities we tend to lump them together, but they're really 3 sections, all right? There's industrial commodities, and they tend to be more tied to the stock market and the economy. Then there are agricultural commodities. Their activity is not tied to the business cycle, right? Because the demand for food doesn't go up and down. That's where supply is the problem. In industrial commodities, it's tied to demand. In the agriculture thing, it's tied to supply. So in order to forecast the agricultural commodities, you would have to know the weather, which really is a big part of it. And then the third set is precious metals, and that's the uncertainty section. Okay, so and some of the precious metals like silver and platinum have industrial uses as well. So there's sort of hybrids between. Gold is the only one that's separate from that. And gold is the one that does best during monetary inflation periods. So you have
a quick question. Microchips. What would you call it? Industrial commodity or microchips? Would you call it an industrial commodity, or or something like fertilizers which go into production of food?
Yeah.
Will you call it not connected to cycles, or because it is related to demand for food?
Right.
Yeah. What is the classification there?
Yeah. Well, for agriculture, anything that's primarily used to grow food is really tied more to a weather cycle than it is to a demand cycle. Okay. And so it's tied to supply. What kind of supply are you getting? Now, of course, you get things like, the Ukraine war, of course, distorted the supply for grain. But again, it was a supply issue. The demand for grain is still the same. It's what supply is at the point. And sometimes with industrial commodities, you can also get supply issues like the Ukrainian war. Sometimes you get it from strikes at copper mines and things like that. But typically, it's really tied to demand. Now, for microchips are, of course, have industrial uses. So that I would assume, I'm not an expert on microchips, but I would assume that they're more tied to industrial uses than anything else. Excuse me. Does that answer your question?
It kind of does, but I'm still grappling with what is the framework.
What is the framework for?
framework for classification of all these items into one category versus another? You see, there seem to be some, or maybe it is the reason for using this fuzzy approach, you know.
Well, that's part of it. Yeah.
Yeah.
Like if you look at my website, you'll see one way of doing it, my way of doing it.
Yeah.
And there are, of course, other people who do work on cycles as well. I don't think they take into account the long cycles the way I do, but still they're there. And it's really a matter of, in the financial system, it's an ebb and flow of capital, and capital tied to interest rates and borrowing, right? That tied with economic growth and other things. They're all interrelated with one another. And what we do is look at separate indicators, credit spreads, for instance, and the volatility indexes measure pretty much the same thing, but they don't seem to always agree. But when they do agree, then you have to be concerned. Okay, that's.
I think I should look at your website, you know, because I think that is where all the answers are, right?
Well, I don't know if all the answers are there, but you'll find some answers there. Yes. And you can always, you can always email me, and I'll be glad to discuss things with you.
Yeah.
There's a lot in the investment world. There's a lot of talk about alternative data, right? So, you know, satellite imaging, on social media posts, and so on. AI is, is the appropriate tool to process all this data. Do you see any trend, any like investors going beyond the traditional like indicators try to get an edge?
Yeah, I think that's certainly happening. It's been happening for a while, and I think that can work. But there are dangers involved. Again, tied to the long cycles. We don't have any satellite images from 1982, so we don't know what was going on back then, and you can't compare. If you want to look at a high volatility regime, now we have a high inflation regime. Now we have 2020, but that was a fairly short period, and that was one type of inflation, really tied to supply more than anything else. If we have a different kind of inflation, if we have monetary-driven inflation, which we haven't had this time, by the way, will the satellite imagery be different? And we don't have any examples to check that with. That's some of the problem with a lot of the new types of data is the fact that it's fairly recent. They're all fairly recent, and that's the thing about the cycles. And there's also in modeling, I know among academics, and practitioners, there's a confusion between about what you need for data sufficiency. Okay, now for some statistical techniques, the more data points you have, the better. But when you're doing cycles, the more time you have, the better. Okay, so I'd rather have 40 years of monthly data than 5-minute data for 1 year. Okay, I'll have more data points with the 5-minute data, but it's not going to tell me anything about the long run. You need like 40 years worth of data to really see cycles, and that's the limitation we're all running into.
Yeah, there's this traditional like Bob Martin's paper about like estimating returns. So you estimate returns or risk. So risk you can estimate it with a relatively short period of time, but for returns, right, you really need a long period, right? Like otherwise it's very uncertain. So we just have only a few minutes left, and so I want to open the floor to questions that you might have. I see someone raising their hand. Okay, so I'm going to unmute you, Bobby. Okay. Okay, Bobby, go ahead.
Hi, thank you. Thank you for a good discussion. So my question is about the investment side. So what are your thoughts on long-term investments that anybody could adopt at this stage, because there is too much volatility in the market? So if you have to build a portfolio, what would be the asset classes and how much percentage that anybody could allocate for a long-term portfolio?
Well, when it comes to long-term portfolios, I I go with the sort of classic asset class allocations, so you do need stocks and bonds. One thing I do on my website for the subscribers is I have a model portfolio, but it just tells you to over and underweight relative to some benchmark, whichever one you want. There I've made the point that one thing that's changed in the last year is the position of cash in a portfolio. Okay. When I first started in investments back in the late 70s and early 80s, the classic balanced portfolio was not 60-40. Okay, that's what everybody says now, but that's not true. It wasn't 60-40. It was 60-30-10. Okay, 10% cash, 60% stocks, 30% bonds, 10% cash. And as cash yields dropped and bonds gave much better returns, everybody dropped the cash part and put that into bonds. Okay, and that was especially true, of course, in the 2000s and even in the 90s when cash yields were far below bond yields. Well, now we have cash yielding 5%, and we have 30-year bonds yielding, 3.8%. It's time to think about having cash in your portfolio. I mean, you have a risk-free 5% return. Stocks and bonds both have to beat that. Okay, and it's a big hurdle, and people haven't thought about that too much because we haven't had to think about it. And so I think that one thing that people should think about now in a portfolio is there should be a position for cash, and of course alternatives, if you can invest in them, are a good idea, but they should be things that you believe are uncorrelated with stocks or bonds. Okay, and so if you do trend following or something like that, those can be good, but you have to be careful that they're not just amplifying your exposure to different markets at different times. So that's what I would say, is that it's basically a stock, bond, cash. Alternatives are the main areas. Commodities are also good, but there again, you have to be wondering about which type of commodities you want to invest in. If you want something that is tied to the business cycle, then it would be industrial commodities rather than agriculture. The use of gold was not important when we didn't have inflation, but now inflation's coming back. It could be important again. It's because that's when it tended to do the best in the past, and so and there's no reason to think that won't happen. The reason it has advantages over things like cryptocurrencies is that it's immortal. Okay, gold is immortal. That's why it's always been the thing people use in times of uncertainty, because you have an ounce of gold, it's always there. It doesn't rot, it doesn't tarnish, it doesn't rot, it doesn't rust away on you. Gold is gold, and it's always there. Bitcoin, I can't say that that's the case. I find it funny that some people who are survivalists evidently invest in cryptocurrencies, because if the big collapse comes, the first thing that's going to go is our electronics. You're going to get your Bitcoin then, but gold is there. So it's something to think about these days now that inflation is back. And I expect one thing I expect, by the way, is I expect inflation to be around 4% for the foreseeable future. I don't think it's going to drop much below that. So we're going to go back to the old days. That was what the old days were, by the way, 4% inflation, not 2%. And the behavior of markets changes when you're in that inflation range of above 2% up to about 6% or so. And that's the state we're in now.
Okay, we're hitting, Bobby, you want to add something?
Yeah. Thank you. So the only question that I have, follow-up question, is that currently the inflation is high. So, but it eats away the cash if we keep it in. If we keep the lot of asset in cash, right? So, but it is better to be investing all the money cash in the stock market, right? I don't see the value in keeping some cash, because it is going to erode away the purchasing price because of the inflation?
Well, it depends on how you measure inflation, right? I mean, if you look at PCE inflation, it's around 4%. So 4% means that cash is giving you a 1% real return, and that's risk-free, right? So you have to think that bonds and stocks are going to give you a better risk-free real return than that in order to invest in them. Now, I'm not saying that you should put everything in cash. Remember, I talked about 60, 30, 10. You know, I think that a holding in cash is worthwhile. Among other things, it's something to keep in case we do get that recession and market values decline. Then you'll have something ready. And in the last 20 years or so, keeping money in cash, waiting for the downturn was always a loser because you weren't making any money in it, right? But now you actually do get something in it. So it's something to think about.
Okay, so thank you very much. We're hitting 6:30. You have been very generous with your time, Edgar. I think we learned a lot. It was very informative, and I hope that everybody will go to your website and read your books and your research and your articles. You are very active on LinkedIn too. So I think that it gives you a nice overview, and it's like, I mean, we try to condense in 90 minutes 40 years of work, right, on research, right. But just give you like a taste of like the extraordinary work and research that Edgar has done. So thank you very much, and thank you everybody to attend. I just want to announce that the next speaker, I think, will be in a couple of weeks. Will be also like someone in talking about AI on finance. Is Alfred Spector, who is an advisor at Blackstone, and who also work in a hedge fund called Two Sigma, which is also a well-known hedge fund. So thank you very much, and good night, everyone. I'll talk to you soon, Edgar. Thank you.
Thank you. Thanks for coming, everybody.